Ray here from Nest Mortgage, and I hope you're all having a great week. And while kids have gotten back to school, it looks like the Bank of Canada has gotten back to work. And so they announced this morning that they are increasing the overnight rate by 0.75%, taking their key policy rate to 3.25%. For those keeping score at home, this is the fifth consecutive rate increase for a grand total of 3% in this cycle, which started in March of this year. So some pretty aggressive tightening. And ultimately, what's important about this particular increase is that now it takes the Bank of Canada into what they deem as restrictive territory. So what that means is that for the Canadian economy, now the policy rate is going to become a drag. It's going to be a drag on consumer spending, a drag on borrowing, ultimately geared towards bringing inflation down, which is ever so stubborn, back into key target rates. Now, the announcement today was really short and probably not so sweet, because one of the takeaways is that they do deem that this policy rate is going to have to increase further. So for those of us in variable rate mortgages, it means the roller coaster ride carries on a little while longer. Now, the extent to which that happens is going to be dictated largely by what economic data comes in, right? How do these inflation numbers look? And we should have another month or two's worth of inflation numbers before the next announcement. And so that will dictate by how much and when the Bank of Canada decides to up their policy rate. Now, the good news is that there can't be that much more, hopefully, in terms of where they go from here. But I think what borrowers really want to know is, what does this do for them and how does this impact their decision making? And really, there are three decisions from my point of view that need to be made. Are you going to stay in your variable rate? Are you going to convert to a fixed rate? Or maybe you're going to look at refinancing to sort of reset that budget. Now, there are arguments to be made for each of those. And on the variable rate side, they're still below where fixed rates are at. Variable rates still come at a discount against today's current fixed rates. And with every increase we see, the likelihood of recession increases down the road, which means rates will probably have to come back down again. So, again, extending that roller coaster ride. On the fixed rate side, fixed rates mean a pretty big step up for most variable rate borrowers. For those that are in capped rate payments or people in variable rate mortgages, moving to a fixed rate means you're automatically beefing up your interest rate and the required payment to go along with it. Now, what's important here is that bond yields, which predict fixed rates, really haven't moved a ton since that 1% increase in July. And what that would tend to indicate is that there's not a whole lot of opportunity cost lost on fixed rates, whether you convert today or next month or in 3 months' time. There doesn't appear to be a ton of upward pressure on fixed rates for the time being. So staying in a variable rate versus a fixed rate, you could stand to save a little bit of money in the near term. Now, the refinance thing gets a little bit more situationally dependent. Odds are you have some equity in your home that you could use to pay out some debts that have accumulated, because let's face it, everything has gone up in price. Or maybe it gives you a chance to reset your budget, extend your amortization, lower your payments, just to take a little bit of the pressure off. So that is going to be situationally dependent, and I'd be happy to go through that with you. So if you have questions on any of this and how all of this applies to you, please don't hesitate to reach out. Be happy to connect. All the best.